Thank you very much for joining session 2 of 4 in our IUA Clauses Committee Policy Wordings series. We are, of course, all living in an increasingly connected world, and it's fair to say that insurance is no exception. And today we're going to be talking about a really important tool for multinational companies to have a connected, comprehensive insurance solution, and that's global programs. I'll briefly introduce myself because I'll be chairing the event today. So I am Tom Hughes and I oversee clauses work at the IUA. And I'll just briefly take you through the series of 4 sessions that we have on the agenda for this year. So we've already provided an update from 2024, a legal lab looking at key cases that have emerged in the last 12 months. Here we are on session 2, Global Insurance Adventures, the passport to coverage. And then a little bit later this year, we'll have session 3 looking at delegated authority and session 4, pollution perils. Now, the agenda for this session today, our speakers are going to take us through the key topics on screen. So an introduction to global programs, a breakdown of their structure and an overview of the key concepts within, and then a look at some of the legal and regulatory considerations. And that should take us through the best part of an hour. Now, before we get into the presentation, I'll answer a question that you might have had in mind, which is what is the IUA? Now, we're the representative for 80 insurers and reinsurers who are active in the company market in London. There'll be lots of familiar names to you on the slide at the moment. Now, we have a number of different class of business committees from marine and aviation to energy, property and casualty. And we run those groups bringing together underwriting and claims practitioners from across those respective classes. Now, one of the key groups within our committee structure is the IUA's Clauses Committee. That group in particular brings together wordings and legal experts to do a few key things. Now, the first is to support market practitioners by publishing model wordings which can be used as drafted, amended, or ignored completely. The second task for us is to monitor case law developments that might impact on policy interpretation. And the final one is to be a thought leader promoting contract clarity and collaboration between stakeholders in the wordings process. We've got about 8 broking firms on the group at the moment, 1 legal representative, and then around 26 of our IUA insurer and reinsurer members. And on screen, you can see some of the clauses we published in the last few years. Now, where can you find these clauses? Well, they are freely accessible and searchable in the IUA Clauses Library online. That library also includes a number of joint marine and aviation clauses that have been published jointly by the IUA and LMA. Now, I will introduce our speakers and we'll get going with the session. So looking at this from a legal perspective, I'll introduce you first to Chris Crane, who is Legal Director at Wikborg Rein. Thank you very much for joining us, Chris. Then we have from a reinsurance broking perspective, Neil Bennett. Neil is Senior Vice President, GC Asia Pacific and Continental Europe at Carpenter. Thank you, Neil. And finally, we have Chloe Adams. Chloe is the Chair of the IUA's Clauses Committee, also Head of Technical Wordings at Markel, so bringing the insurer perspective today. And with that, I will pass over to Neil and we'll get going with the session.
I'm going to talk about what global programs are, and who buys them and why they exist. Okay, so I'm going to give you the skeleton, and then Chloe and Chris are going to add the meat to the bones. Okay, so without further ado, who buys global programs? At Marsh, there's a definition that only 2 territories are required that an insured operates in for a global program to be required. So that gives us multinationals, NGOs, or regional companies that may have operations in a certain part of the world. Why do they buy them? Well, covering risk today, across multiple territories is very challenging. You've got different legal systems, and you will have different fiscal requirements. So an insured may want to have one point of reference with one broker and one insurer to provide them with all their insurance needs. So if you can imagine a car manufacturer headquartered in Germany and they've got operations on 6 continents, they may not want to deal with multiple insurers, but only one insurer to manage all their assets overseas. Now, obviously, different clients will have different needs, and the client will have to discuss with their broker insurer, and it will depend on the complexity of their business and also their strategy as towards risk and the businesses in each territory. But what they will want is an economy of scale, consistency in their claims handling, and efficiency in where and how the premiums are paid, taking into account tax issues. And they'll also want a central monitoring ability to make sure they can measure the outputs from that program. And of course, ensure that their relationship with the insurer is improved. So, as I said, the car manufacturer in Germany with the broker, does the law in those territories that they're operating require the local subsidiary to purchase locally, or can they insure with an insurer based overseas, so non-admitted? And does the local insurer have to pay tax locally? Also, how can claims be settled? Is it locally, or can those claims be settled directly with the holding company back in Germany? So what are global programs? Basically, they're a coordinated set of insurance policies to provide consistent and compliant coverage for those insureds that are operating across multiple countries. As said earlier, the structure of the program will be dependent on the size and complexity of the insured. They may only have one operation that is outside of their home jurisdiction, and that may only require a simple policy issued with a fronting agreement in place that takes the program back to their home country insurer. They might use non-admitted programs, but that is obviously dependent on the jurisdiction in which they operate. And then what we're talking about today, a global program with a master policy, and that will be combined with a number of local policies, providing each of their subsidiaries with the required coverage. Now, here's a very basic illustration of what a global master program would look like. Is you're going to have local policies that are going to give you the minimum coverage required in those territories. They may also give additional coverage that you don't need elsewhere. One of the examples is you might need nuclear cover in France, but that is not required elsewhere. Then the master policy is going to give you a bigger limit where required, and it also will provide for coverage that is not available or not normally given locally. And this is where we talk about difference in conditions and difference in limits, which Chloe will explain detail later. So, who are the key parties to this transaction? Well, obviously the buyer, the insured, who wants to have the following needs met. Confidence, they need to be confident that they're going to have coverage for all their assets and liability requirements. The policy is going to be compliant in all the territories that they operate in, not that they find that one of the policies issued that is outside the local law, which could give them reputational problems. They want consistency in the coverage that is afforded, and claims, they want consistency in how those claims are dealt with and where they will actually be paid. And of course, they want certainty. They want certainty that the coverage is going to be there, and also that any exposures that they've got are going to be covered. And of course, they'd like to see some savings by buying one program that is managed locally, so cost efficiency. The broker, what is their role? Well, obviously the broker that is dealing with the head office needs to be able to provide all the relevant services that the client wants. They need to be able to have a network of offices that can communicate with each other seamlessly. What you don't want is offices to act in silos, but you want one office that is going to manage the whole process and have very good communications with all of their colleagues in the overseas offices. They should also have the ability to work off one common platform. This is for administrative reasons, as well as being able then to provide that management information that gives the client all the information on how their insurance program is running. Are they going to be able to see which territories are providing them with any problems, and can that be resolved? If you don't have one system and great management information details, that's going to become difficult to manage. And of course, last but not least, the insurer. And like the broker, they should have a network of local offices sufficient to provide the services for both the buyer and the broker. And that can extend to claim services and risk assessment services. And this could be a global insurer, or it could be a combination of a global insurer that leads the master policy, and where that insurer doesn't have access to their own offices, be able to work with local insurers. But overall, for the program to be successful, there needs to be communication with all the parties. That gives the parties access to each other. The client needs to be able to access both the broker and the insurer. The insurer and the broker need to fully understand the client's needs, and they also need to be able to act and respond to any changes at the local level that could impact the client in terms of coverage or legal requirements in that policy. So key to this is communication. And with that, I'll pass over to Chloe.
Thanks, Neil. Excellent. So I will come on to talk about kind of the key concepts of kind of a global or master program from an insurer perspective. And as Neil mentioned, touch on some of those aspects such as stick deal and think that kind of help us make these facilities work for the client in the best way possible. So starting off for us with our kind of key considerations. So from an insurer's perspective, things that we will be thinking about when we're dealing with a global or a master program is initially the program design and structure. So to make sure that it's there to fit the client's global operations and to design a program that balances those kind of local compliance regulations and rules with kind of an element of global consistency. So this includes structuring that kind of master policy and determining whether the local policies are needed, and also whether there are any alternatives needed, such as a financial interest clause, perhaps, to make sure that their program can work. The next thing we think about is things like regulatory compliance. So we are in charge of making sure that those kind of local policies and anything that we're doing in those local territories complies with the laws and the regulations there. So this might mean where perhaps insurers don't have that kind of local office support, that we might need to work with local legal partners or third parties to help us achieve that, but to make sure that we're staying on top of those rules and regs in those issues. Then it's thinking about policy issuance. So we want to make sure that there is an element of timely and accurate policy issuance to the clients, and to make sure that, again, thinking about the rules and regs, that we don't end up non-complying with any kind of timelines in those specific areas, and to make sure that what we are giving out from a documentation perspective is ensuring clarity and enforceability for both us and for the client. We also then want to make sure that we're thinking about that kind of claims management and oversight piece. The idea being one of the benefits of these programs is to ensure that there is an element of consistency in that kind of claims handling process. So we will be thinking about how, as insurers, we will need to handle that, whether, again, we would need to think about third-party assistance or local representation. And then finally, again, on the kind of communication, is making sure that we've got strong communication with both the client and the broker, and making sure we're proactive to make sure we can explain how a program's going to work, how we might resolve any issues that arise across different jurisdictions, and again, making sure that chain of communication is open so that it fits the client's needs and what they're expecting. So thinking about all of the different components then, the first component would be the master policy. So what we're thinking here is it's generally seen as almost the blueprint. So it's the global blueprint for the coverage. It's where we're setting out that kind of central store of insurance terms that's going to be used for that kind of multinational client. So it's there to set the bar for that uniform coverage and that global oversight for all of the participating countries that we're using here for that multinational contract, and it's designed to ensure an element of consistency, compliance, and control essentially over those local policies, so that we kind of know roughly what the coverage is going to be. And I'll come on to where there are coverage differences in a moment. So the design will act as an umbrella. As I say, it will coordinate the local policies and pull all those together and kind of set that coverage blueprint. It ensures kind of coverage harmonisation across the jurisdictions where we can, and supplements or overrides the local policies. Again, we'll talk about difference in conditions where it needs to be able to make sure that we're offering the cover that is needed. So when we're thinking about the master policy, some of the key considerations that we will be thinking about is that it's not going to be legally recognised in all countries. So it is powerful, it is there to set that blueprint, but it won't mean that we can bypass any element of the licensing restrictions. So it won't allow us to then offer like non-admitted insurance. So we can't directly respond in every territory. So therefore, that's when we will need to be thinking about either the local policy, perhaps a financial interest clause, which we'll come on and talk about. But it again sets that ability for us to set the standard on coverage. It also then means that we need to think about coordination again with those local brokers and those legal teams to get those alternatives in place. So we need to make sure that it fits the risk appetite. We need to identify where the local policies might fall short or where there isn't one, and to be able to fill those gaps. So it really is a team effort. It is about collaboration with those local offices, the client and the broker, to make sure that we are achieving success. So then when we think about what the local and admitted policies are, so this is where you have the master umbrella programme, but there is a necessity through not being able to write in that vicinity locally or on admitted paper to then offer a local policy as a potential alternative to that. So what we try and do there is we need to think about the compliance with the local regulations for that particular policies. So it might need different terms and conditions, it might need to be issued in a different way, they might have different documents that form the policy suite. So it's about thinking about all of those and making sure that we're handling them properly. Non-compliance in that area could mean we end up with fines, penalties, or sometimes even an invalidation of coverage, which isn't what we want to leave our client with. Then it's thinking about local claims handling procedures, so whether there's an element there that we need some servicing in place, whether there's aspects that we need to consider by law that ensures there's kind of faster and more appropriate responses in that particular area. We might need to think about premium and tax obligations, which I know Chris will touch on a little bit in his section. We also then need to think about the actual standard of the wording itself. So these wordings should ideally have been vetted to make sure that they are in compliance with that local appetite and all of those local rules. There's also an understanding from the underwriters themselves as to what's actually in those forms, to make sure that we're making sure there is a link between the master policy and the local policy, or to be aware of where there are inconsistencies between the two. And again, thinking about that issuance and making sure we're getting everything out without delay and adhering to the requirements we need to. The other aspect to think about is how manuscript potentially those local policies are. So if we have a requirement in that local jurisdiction to have forms that are filed, i.e. they're much more regulated, they have to be standardised with a regulator. If we then put forward a manuscript form and we haven't addressed those requirements, it might mean we're out of step, and also it could mean that it's not going to be okay for us to implement that wording, and it could leave the client with a bit of detriment in that sense. So also as well, it's thinking about the differences as you manuscript in those local policies between the master policy and whether you have adequate provisions in both the master policy to kind of cater for those differences. And it just means it's quite hard from an underwriting perspective to keep an eye on all of those different coverages being offered in those different areas. The other thing to think about is that without a local policy on a good local form, then it could be that our client or that multinational company may then lack the coverage that they need in that local market, and also something that might be common in that local market. So we don't want to end up where the product that we're selling or the product that they have purchased is out of step with what would be a local competing product. So we want to make sure that it's there, giving them the coverage that they need. So then we come on to one of the areas where we can try to help those differences, and we call this difference in conditions. So why do we need it? So it's here to help when we have local policies in place to fill those kind of coverage gaps where the local policies are in a more restrictive position than potentially in the master policy or that umbrella policy. So they are there to kind of be the glue, be the glue that holds together that master programme, and to ensure that we're trying to offer that uniform global coverage despite that local policy limitation or difference. So it's there to help protect the client against any inconsistent terms, exclusions or sublimits, and to allow the parent company as well to have that oversight and control of their entire global risk and to understand that kind of cover there. So I've put an example below, so of where a DIC clause might be triggered. So it might be that the local policy doesn't cover a particular peril or a condition or a coverage. So for example, in this case, the local policy excludes cyber liability, but the master policy includes it. So the DIC would respond to extend the cover to give that local area the cyber claim in that jurisdiction. But key considerations for us to think about with DIC clauses, again, we need to make sure, as with everything, that they're carefully worded to avoid any kind of conflicts with local regulations. They are there to help with the gaps, and they're not there to put them in a worse position. They are there when we are operating normally on a non-admitted basis and you have that local policy in place, just to make sure that we kind of keep that there, because you need the local policy in place, otherwise there is no DIC situation. Without that local policy, there is nothing there to fill the gap against. So it is a case of whether then the DIC would be the appropriate position for you to use. Then we come on to DIL, difference in limits. So this is similar to the difference in conditions clause. So what we're dealing with here is that it's limits based. So if you've got a master policy that has wider limits than what is potentially on the local policy, then the master policy can then effectively step in to bridge the gap again and to top up the coverage limits there. So this might be a useful tool for those kind of local offices and for the client themselves to top up for large losses where potentially some of those local limits are insufficient to cover that total loss. So as per the DIC, we've got a little example. So where a claim exceeds the local policy limit, but it's within the master policy's higher limit, then what we'll have is the local policy potentially has only $1 million limit, master policy has a $5 million limit. So the DIC and the DIL, sorry, will cover that additional 4 million in the excess to pick up the gap. So again, thinking about where this might be useful, where you've got those local policies, but in those jurisdictions, they potentially have low statutory limits. So we might be there to top that up. We also need to think about how it needs to be coordinated with those kind of local fronting insurers themselves so that we're not doubling up on coverage or also potentially creating any further gaps. And thinking again about those claims handling protocols and how we're going to handle that DIL situation. And again, thinking about making sure we're using it in the right place. So where we're on a non-admitted basis and we can look at what's on that local policy and work out where that DIL situation might kick in. So then thinking about some of the potential issues when we use DIC or DIL clauses is there are kind of non-admitted insurance restrictions. So for example, in countries like Brazil, Russia, India and China, non-admitted insurance is not permitted. So therefore, without that kind of local policy and that ability to operate in that local policy, master policy chain, it might mean that we can't actually work with these types of clauses. There needs to be a local policy in place. So we're not going to be able to use a DIC DIL because there's, as I say, nothing to fill the gap against. So then it's thinking again about the claims handling complexity. So, understanding if we can make the claim payment itself and how that would work, and to make sure that everyone, again, is clear on their roles and requirements in that kind of claims handling process. And again, thinking about where those tax and regulatory implications might kick in. Chris will cover some of this later in his section, but again, we need to make sure that we clearly define the payment mechanisms to avoid any level of kind of legal exposure in that sense. So then coming on to what happens where we don't have the ability to operate with a local policy, and what is our alternative? So enters the financial interest clause. So purpose of the financial interest clause is there to allow the parent company, so normally our client or that main named insured on the master policy, to claim for its financial loss resulting from damage or liability incurred from one of their kind of foreign or multinational subsidiaries. So it's there as not a direct indemnity to that particular subsidiary, but rather as a reimbursement to the parent for that potentially diminished value or that financial loss that they have suffered on behalf of the loss being suffered at that subsidiary. So it's there to provide coverage where we can't issue those local policies, and it's there, as I said, to kind of keep that protection for the parent company. So we use it to bridge the gap as an alternative. It can be, an area whereas we can use it if potentially we can't actually get to the crux of those kind of legal and regulatory environments. So it might be it's particularly complex, or it might be unclear. So the FINC clause might be a good alternative there. And also it might be a good alternative where the actual subsidiary itself isn't named or isn't covered under a particular local policy. So we can put these kind of FINC clauses in place to help them maintain that element of coverage. But ultimately as well, again, going back to that named client or that named parent, is it gives them the ability to understand their global coverage and maintain an element of control and oversight over their entire program and how that coverage is being afforded. So as with everything, things that we need to be thinking about and kind of the implications of using FINC, they are a fallback position. So it shouldn't be seen as a replacement for a local policy where you should be using one. So it doesn't replace the need They are there to reimburse the parent company. They are not there to reimburse who, the local cedant or that local subsidiary who would have had that local policy. So they need to be drafted carefully and kind of full awareness of that legal constraint and how it's set up. So on that vein as well, they won't be seen as a recognised substitute for a local policy as well. So again, if you have a requirement to issue a local policy and you issue a FINC, it might mean that local jurisdiction won't recognise it and they won't accept that as fulfilling that local insurance requirement, especially when you're looking at things like compulsory covers such as workers' comp or motor. Again, think about those tax implications. Any kind of payments under FINC might be taxed, so we'll come on to that in a bit more detail. And again, thinking about that element of claims complexity. If the claim is paid at the parent level, making sure that we're gathering enough evidence and validating that kind of financial interest can sometimes be quite time consuming and contentious. So it's just making sure you're really clear. And again, thinking, as always, when we talk about our contracts, is the drafting. So we need to make sure that they're drafted clearly and without ambiguity. For example, when we're talking about what does a financial interest constitute in these clauses, it's essential that the clause clearly defines what that is so that we know exactly at what point it kicks in and how we can work that out. We will also do a shameless plug here for the IUA's financial interest clause. It is available on the clauses library and also comes with some really good guidance alongside it on how it's used and some of the drafting mechanisms that went into it as well. So it's a great tool to start with if you do need one to start with. So some of the other key considerations for insurers. So is thinking about the territorial limits. So territorial limits, they define where the policy is valid or where the coverage is being afforded. So it's crucial that they do match the client's operations, which might sound very silly, but for example, if the client's got subsidiaries in Africa or the Middle East, but the master policy only covers Europe and North America, it's going to be a major gap for their operations. So it is being mindful of any exclusions and thinking about also things that might include areas that are sanctioned or areas that are potentially outside of underwriting appetite for the insurer. These things need to be clearly communicated back to the client. We also can think about things like claims control and cooperation. So, where we are giving rights for the insurers to kind of be directly involved in those claims, it just helps manage those large exposures and gives you that consistency and that kind of claims handling across that global program. But it also means that it can kind of enhance response time and potentially avoid any duplication or conflicts between kind of master and local policy level. The other thing is to think about is cancellation. So again, there will sometimes be a conflict in these terms between local policies and master policies. Notice periods might differ between the different coverages being offered or where they're being offered country to country. And sometimes you might have a situation where the local laws have a operation of overriding those master policy terms. So again, it's always making sure that from an insurer perspective, we're clear what's happening, but also for the client as well, that they understand what their cancellation rights are and where these are going to be effective and when. Again, law and jurisdiction. So the master policy will typically state what that will be subject to, but sometimes the local policies will have their own local law, and this can create conflicts when we get to disputes. So again, it's always making sure that we understand where that situation might arise, where there might be certain terms and conditions that are going to override each other, and also making sure that we are clear in the event of a dispute, potentially which law is going to apply and manage clients' expectations accordingly. And then finally, language issues. So when we are dealing with local policies, sometimes that kind of language element is one of the things that gets overlooked. So some local policies will have an actual requirement that a policy needs to be issued in local language. So where that is the case, insurers are going to be wary to where they need to get translations. It might not always be a necessity. It might just be a recommendation, but there are a lot of territories that require it has to be in local language. So therefore, if you've only issued something in English, you are going to have to look to have that translated, and not Google free translate. It probably will have to be a legal translation to make sure that you maintain the meaning in your terms. There might also be alternative So where there isn't a requirement to have it in local language, sometimes you can use language declaration clauses, which allows you to issue it in English, providing that the client is happy to receive it in such. But otherwise, it is a case that you are going to have to be wary of all those different language requirements and what that might mean when you're issuing those local policies. So with that, I will hand over to Chris to walk us through the legal and reg considerations.
Thanks, Chloe. I'll be discussing some of the important legal and regulatory considerations that insurers, brokers, and policyholders should have in mind when designing a global program. Almost every country in the world legislates to control the way in which insurance business is transacted. Governments and regulators have a range of public interest objectives, including protecting policyholder interests, maintaining solvency of insurance companies, ensuring confidence and stability in the insurance sector, making sure that insurance is available across the board, and retaining premiums in the territory. And they use a range of mechanisms to achieve those objectives, including licensing requirements to control who can provide insurance and insurance services in the jurisdiction, mandatory insurance classes and coverage, specific requirements relating to policy terms, form and language, policyholder and consumer protection and conduct rules, capital and solvency requirements, restrictions on reinsurance, insurance premium tax and other fiscal controls, and rules relating to claims handling and payments. So compliance issues can affect the parties involved in a program in different ways. So ensuring regulatory compliance across all of the relevant jurisdictions is a major consideration not only for insurers, but also for policyholders and their brokers. The most obvious consideration is to ensure that cover operates as intended and is enforceable in all territories covered by the programme. But as Neil and Chloe have pointed out, breaches of local regulations could also lead to potentially severe penalties, including fines, back taxes, and even criminal liability, depending on the nature of the offence. Two key considerations that lie at the heart of ensuring compliance are first, the use of non-admitted insurance, and second, the proper allocation of premium and the proper payment of insurance premium tax in all territories where cover is provided. By way of reminder, admitted insurance refers to coverage provided by insurers that are formally licensed by the regulators within that territory. On the other hand, if an insurer provides cover for assets or liabilities in a territory but is not licensed there, then the insurance is referred to as non-admitted. Some territories allow non-admitted cover, others do not, whilst others only allow it under certain conditions and subject to certain restrictions. Each country has its own rules, and these vary considerably from country to country, ranging across the spectrum from a completely unrestricted market where non-compulsory insurance can be bought freely inside and outside of the country, to a full state monopoly where insurers are state-controlled and insurance is only available from government agencies. And there are many shades of grey in between. And the complexity is compounded by the fact that within each country, there may be different rules for different classes of business. Having all local cover underwritten by admitted insurers is certainly likely to ensure full compliance, but purchasing insurance at subsidiary level can be inefficient and expensive. It can also result in coverage gaps, lack of control over claims, and can lead to accumulation and capacity problems. So the aim of the global program is to achieve a balance between consistent coverage and international compliance. This needs a detailed dialogue between the risk managers, brokers, and insurers to identify where cover is needed and to ensure that the cover that's provided in the territory meets all applicable local rules. One area that requires particular focus is how premium is allocated between the cover provided under the programme and where insurance premium tax must be paid. In a landmark case in 2001, a Norwegian engineering company took out global professional indemnity policy for its group companies, including a Dutch subsidiary. The policy was taken out in the UK and the company paid only UK IPT on all coverage. But the Dutch tax authorities challenged this, and the ECJ ultimately determined that IPT was due and the risk was located where the risk was located. So Dutch IPT was due on the Dutch subsidiary's element of the policy. This case served to highlight how providing cover across borders can result in unexpected tax liabilities. But more generally, it illustrates how cross-border coverage can trigger overseas regulations in the place where the risk is located. So a consistent approach to premium allocation using a robust methodology which reflects the true allocation of risk is therefore essential for a company to defend itself against charges of non-payment of IPT. As Chloe explained, one of the tools that's used to ensure legal and regulatory compliance in jurisdictions where non-admitted cover is not permitted is the use of financial interest cover. Chloe's already provided an excellent overview of the cover. I'll just focus briefly on one or two of the legal issues that arise. So the fundamental principle that underpins financial interest cover is that subsidiaries located in countries where non-admitted cover is not permitted are expressly not insured and have no rights under the global master policy. Instead, the parent company is covered in respect of any loss to its financial interest in its uninsured subsidiaries. The idea is that if an uninsured subsidiary suffers a loss, then it diminishes the value of the parent's shareholding, and it's that, the parent's financial loss, that is covered. As the local subsidiaries are not covered under the global policy, they will not be in breach of any local requirements that may apply. However, as Chloe said, financial interest cover is not a panacea and needs to be deployed carefully. From an English law perspective, a suitable and well-drafted financial interest clause should be valid and enforceable. And elsewhere, the Adidas case in 2019 in India's Income and Tax Appellate Tribunal supports the validity of financial interest clauses in India. But it's important to point out that financial interest clauses have not been widely tested, and regulators in different jurisdictions may take different views. Whilst local subsidiaries may not be covered, some regulators could potentially view financial interest cover as a technical attempt to evade local regulatory requirements. There are also coverage limitations. So, for example, certain types of loss that don't result in a loss to the uninsured subsidiary, such as Side A D&O claims, cannot be covered under the clause. And as there's no local claims handling or direct payment, it may not be suitable for subsidiaries with high frequency claims or particularly complex loss scenarios. In addition, if it's not carefully drafted, a financial interest clause can also give rise to uncertainty in quantifying loss. So, for example, where the subsidiary is not wholly owned by the parent, or where the loss suffered by the subsidiary does not automatically translate into a readily measurable drop in the value of the parent shareholding. These issues can be addressed by careful drafting as agreed value policies, where the financial interest loss suffered by the parent is agreed to be valued as equivalent to the uninsured loss suffered by the subsidiary. However, parties do need to consider whether this is appropriate in all the circumstances. Policyholders also need to be aware of the accounting and tax implications. As only the insured party is the parent company, all premiums must be paid by the parent, and any claims monies can only be paid to the parent. So if the parent company then looks to pass on the claims payment monies to a subsidiary, this can potentially give rise to tax issues, as the onwards claims payment may be regarded as a capital injection, which gives rise to an additional tax liability. So careful thought must be given at the outset as to how cover is intended to operate in order to avoid unexpected surprises later in time when there's a claim. Leaving financial interest cover to one side, there are various aspects to claims handling under global programs that require careful consideration. On a very simple level, claims processes vary around the world due to different legal systems, languages, and practices. And claims may be triggered on both local policies and the master policy. It's therefore vital for clear protocols to be agreed in advance. What are the notification requirements? Are claims to be handled locally or centrally? What are the reporting and information requirements? Where cover is provided on a non-admitted basis, a global carrier may be prohibited from providing claim services or making claims payments locally. Parties therefore need to consider how claims will be investigated, managed, and adjusted in all applicable jurisdictions. Payment of claims also needs to be agreed and established at the outset. Where and to whom will claim payments be made? Local policies will mean that payments are made locally, but if the master picks up the claim, there is some ambiguity about how insurance payments provided by the top-up dill cover in master policies are treated. If there's been no allocation of premium to the local subsidiary in respect of the dill cover, then a claims payment to that subsidiary might be regarded as taxable income. And there could be a further legal issue if no premium tax has been paid in that particular territory in respect of the dill cover, which could give rise to a liability to pay back taxes. So a thorough analysis of potential claim scenarios and to whom claims payments will be made in each scenario really needs to be carried out as part of the premium allocation exercise. A final point to note on claims is the complexity of choice of law and jurisdiction issues that can arise from providing cover across multiple jurisdictions through master and local policies. The master policy typically specifies a governing law and exclusive jurisdiction. However, local policies may be subject to mandatory local law and jurisdiction requirements. If there are coverage disputes, this can lead to considerable uncertainty as to where the dispute should be determined and what law should apply. For example, the choice of law and jurisdiction in the master policy may not be effective and enforceable in every jurisdiction where coverage is provided, or there may be situations where it's more advantageous for either the insured or the insurer to have a dispute heard in a particular jurisdiction. So this can lead to potentially lead to parallel litigation in different countries or satellite litigation to resolve jurisdiction disputes. And that in turn, of course, leads to increased costs, potentially inconsistent judgments, and potentially even enforcement challenges. So it may not be possible to completely resolve or address these issues in the program structure or policy wording, but as far as possible, parties should look to build in as much clarity and alignment as far as possible across the dispute resolution provisions in the program. To finish, I will briefly mention three important areas of compliance. These issues are relevant to all policies, but they are even more important in the context of an international program. In many territories, regulators and supervisory authorities impose formal requirements on insurance products. So, for example, in the UK, contract certainty means that all terms and conditions of a policy must be agreed and documented before the policy's inception. Under French law, exclusion clauses must comply with strict requirements that they must be clearly visible and clearly defined. And in China, requires regulatory approval for custom wordings. Those are just to name a few. So parties therefore need to work together to comply with all local formalities and to issue fully compliant local policies before policy inception to avoid potential coverage gaps. Data protection issues can arise at both the underwriting and claims stages due to the different types and volumes of personal data that may be collected, processed, and in some cases transferred cross-border. Different data privacy regimes may apply, so it's really important to map out all applicable laws and to make sure and implement robust safeguards and protocols for data transfers. Finally, ongoing compliance with international sanctions regimes, particularly the EU, UK, and US, is a critical element of global insurance programs. Each part of the program must comply with applicable sanctions laws, and this will inevitably involve a combination of the use of standard clauses to exclude coverage or terminate policies if sanctions apply, use of geographical restrictions to exclude particularly high-risk countries such as Iran or North Korea from coverage, dedicated compliance teams to monitor and interpret sanctions laws, the use of KYC and screening tools to screen names, locations, vessels, even cargo against sanctions lists, and checking claims for potential sanctions exposure before payment, and establishing processes for reporting suspected sanctions breaches. These actions will need to be taken on an ongoing basis. So with that quick canter, I will hand back to Tom to wrap up.
Thank you very much, Chris, and thanks also to Chloe and Neil. There was a huge amount to get through there, and for those of you that have made it through the recording, hopefully you've picked up plenty along the way. So we'll just move forward in the slides and take a moment to look at commercial risks view on why you might need a global program as an insured, and they put together a helpful top 10 for us all to have a look at. And it begins at number 1, focusing on control, and then moves on to ensuring you don't have gaps and that there's consistency in cover. It mentions cost savings, helping subsidiaries with retentions, rewarding better risks. And then we quite enjoyed the final one, which is the air miles, I think, for servicing all of the various jurisdictions. But a helpful summary of the importance of global programs. And I think from my perspective, a very helpful session that Chris, Chloe and Neil kindly put together for us. So really just to say a final thanks for tuning in to session 2. As I said at the very outset, we have session 3 and 4 on the horizon that will be taking place in person and will again be recording after summer. So hopefully we will speak to as many of you as possible around then. Thank you all very much.